My guest, John Buckingham, he doesn't like to pay full price for anything. He's a value player. He's on the hunt for bruised and beaten down stocks that have a bright future. And John joins us from the offices of Al Frank Asset Management in Laguna Beach, California. John Buckingham, welcome to the program.
How you doing, Pim?
I'm good, John. So, all right, now, is it getting harder to be the kind of value investor that you like to be? I mean, you don't like to pay full value for anything. You like to pick things up on the cheap. Is it more difficult now?
Well, certainly it is. We were kids in the candy store back in March, February, March, April, when everything was cheap. Now, many stocks have risen dramatically, and we've been finding a few more names to sell out of our portfolios these days because of the significant rally we've had. But having said that, there are still tremendous opportunities out there in our view. You just really have to be selective because so much has risen here, and some stocks have rallied maybe independent of the fundamentals and where they should be. So you want to be careful, but still lots of opportunity, provided you, of course, have a strong stomach and a long-term investment time horizon.
All right. Now, John Buckingham, you talked about taking some profits, perhaps. Have you taken any profits on on your leaders?
Well, we've trimmed back on some of the micro-cap names that have rallied significantly. When you have a stock like this week, a company called Clearfield, CLFD is a ticker symbol, has had an enormous move up. And in some of our accounts, we got a little rich in terms of the weighting. So you want to remove a little risk from a portfolio by selling some of that. And that's what we've seen here over the last couple of weeks. A lot of the tiny stocks, we like to call them nano caps, they've rallied significantly. And, you can double in a couple of weeks in some of these, and nobody will ever notice what happened to them.
All right. Well, now put your finger, pun intended, put your finger on one stock I know you want to talk about. And my question is, on what basis do you figure out that the stock is inexpensive? I mean, we look at what, price to sales, price to what, price to book? Talk about the company that you've got your finger on.
Well, I'll get to that one in a second, but our investment strategy has been what we've been implementing for 32 years here at the Prudent Speculator newsletter, and that's always been about buying things on sale, buying companies trading for low PE ratios, low price to sales ratios, and low price to book value ratios. The company that you're hinting at is called Authentic, ticker symbol AUTH. $60 million market cap, so it is one of those nano cap names that really hasn't moved. In fact, it's actually moved in the wrong direction. So they make semiconductors that are used in biometrics to detect fingerprints, and obviously to allow your computer. I have one on my laptop to ensure that it's me. And it's an area we think has excellent long-term growth potential. Revenues are growing. Now, here's a company, though, that from a value investor standpoint, it's not making any money today. It's not losing a lot of money, but not making any money at present. But the reason that we're able to invest in a name like this is that they have a fantastic balance sheet loaded with cash, about $2.06, believe it or not, in cash per share, no debt on the balance sheet, and the stock's around $2.10. So you're paying nothing, essentially, for the business today. And if we like an underlying business story for the long term, and we have that margin of safety with the balance sheet strength, that tends to get us intrigued about smaller cap names like this.
John, just a quick question. So, I mean, don't most investors or potential investors know all about the cash on the balance sheet?
Well, you would think they would, but many investors don't really do their homework when it comes to balance sheet analysis. So a lot of these smaller cap names obviously get overlooked by the major analysts, but many investors don't really pay attention to that. You focus on a top line, a bottom line, and maybe a story, but not on any of the kind of additional metrics that maybe you should. And you can go back to like Apple Computer, 5-6 years ago.
All right. Well, John, that's why we have you to do all this deep homework for us. We're going to continue the conversation with John Buckingham. He's got a grocery store chain. They did an acquisition. We'll tell you about it and why he likes the stock. Finding value plays in this market and what to look for. We're talking to John Buckingham of Al Frank Asset Management. He joins us from Laguna Beach, California. John is an expert at finding value. He doesn't like to pay full price for anything. And that, well, maybe that accounts for the fact that you're interested in super value, John. I mean, you do your own shopping at super value, and indeed you also like the stock. What about their acquisition of Albertsons? Then tell me about the company.
Right. Well, grocery store operator SuperValu certainly struggled to mesh the Albertsons acquisition. Of course, they went out and did it at sort of the peak of the consumer cycle, and timing is everything in life. And for them, timing was awful, and the stock price reflects that. So the stock price is down significantly, but you still have a company earning more than $2 a share and sporting a dividend yield of 5%. Now, they have a new CEO who's come over from Walmart, and so they are really starting to compete more on price than they might have in the past. So it's definitely a turnaround story, but again, I like to invest, especially in this market, after we've rallied so significantly, in names that haven't participated in the rally. Now, yes, some would argue SuperValu might be a value trap, but we actually do think it's a super value, and we are getting paid a handsome yield while we await the market's rediscovery of this particular stock.
All right, now in SuperValu's case, also just give us a bit on the world of brands, because I mean they are really pushing their generic brands, correct?
Right. Well, the private label is certainly something that consumers are focusing now, as it's obviously providing a value, and there are higher margins in that area. So yes, they are focusing on that. The problem they've had, of course, is managing investor and analyst expectations, because they've missed earnings numbers here the last several quarters, and that's of course a no-no when you're trying to curry favor from Wall Street.
But do you use that sometimes as a sign? You know, when you see these consistent misses, they come up on your radar screen and you say, aha, now's the time to actually do even more investigation when you get the miss.
Well, absolutely, and often when you get the miss is when you get the great opportunity. And of course the trick is to make sure that miss is not going to lead to 4 or 5 more misses, or have them violate covenants in their debt agreements and things like that. So it's never easy, but we're always doing our homework, our research. We've got a great team here that is crunching numbers all day long. And we think that SuperValu in a broadly diversified portfolio, which we always favor, is an excellent name, especially when you're getting a 5% yield. And keep in mind, you're getting 7 basis points on average in a money market fund these days.
Talk about another company I know is American Financial Group. This is a specialty insurance company. And what is it, trading at like 1 times book?
Right, about that. I'm one of the least expensive of the property and casualty insurers. Here again, you get a nice dividend yield, and most of the financial stocks have had a significant rebound from the depths. AFG has certainly rallied off the lows, but nowhere near as much as some of the other names out there. So again, we think that when you're paying an inexpensive price here, about 6 times forward earnings, and right around tangible book value, and you get a decent dividend yield, we think that's the way to go in any market, but especially in a market that's just gone up 50 or 60%.
All right. Now, the last thing I want to ask you about, this is Marathon Oil, symbol MRO. I didn't know you were going to go for an integrated, for a large oil company. Why hasn't the stock moved? I mean, oil's over $70 a barrel, $73, $74. What happened at Marathon?
Right. Well, we're equal opportunity stock pickers, so we'll have a nano cap or a small cap, a mid cap, a large cap. We're all cap managers, and Marathon's a name that we think is attractive today precisely because it hasn't moved. Now, why is that the case? Well, they are an integrated oil company, and they do have refining operations. And if you've paid attention to the pure play refiners, the Valeros of the world, those stocks have performed miserably. And so the integrated oil companies have also not really been the area investors have gravitated toward. They've actually bought the commodity, or they've focused more on the pure play E&P, exploration and production companies. A name like Apache is a name we like quite a bit. They also are focusing on companies in the drilling space, and we have like a company like Noble Corp. NE is the ticker symbol there. So there is opportunity in the oil patch still. But some of the names really haven't had anywhere near the success that you might imagine.
Let me just ask you about Marathon, because they've got operations in the Canadian oil sands. I mean, can they be profitable with oil at $72, $73 a barrel, or is that still too low?
Well, I don't know the exact number where the profitability line is, but it's what we like to call as it's an option, if you will, on the success of the oil sands. Certainly last year there was a lot of interest in Alberta and the oil sands area, and investors bid up stocks associated with that, Marathon included. Now they've come back down, and I think you have a great opportunity. If you think oil prices are going significantly higher, this is a safer way, in my view, and you get a nice dividend here again, a safer way to play the rising oil price rather than jumping into a ETF focused on crude at this level.
All right. I want to thank you very much, John Buckingham from Al Frank Asset Management, showing us the way to not pay retail for stocks.